China is looking to give US regulators full access to audit documents, but it really hasn't caused Chinese shares to surge like we would have expected to happen based on this news. And why exactly is that? That's what we're gonna dig into in this video. So guys, smash that like button and subscribe if you're new. You're watching More Money, let's get it. What's up guys, and welcome back. So right away from this article, you can see that China is weighing their options in giving the US regulators full access to audits of most Chinese firms. And this is phenomenal news because this was what all of the delisting fears were over. And it's what prompted the sell-off early in the year as some firms started to get notifications that their time was running out in order for them to be listed on US markets. Now, this article goes on to say that Chinese authorities are preparing to give US regulators full access to auditing reports of the majority of the 200 plus companies that are listed in New York as soon as mid-2022. And this seems to be a rare concession to prevent a further decoupling between the two nations. And in my opinion, that's a good thing. If at the end of the day your audits are done well and your audit documentation is tight, then you shouldn't have an issue with giving US regulators access to your audit reports. Here in Canada, when we have companies that are dual listed or companies that are listed in the US, we have no problem with giving the US access to the audit documents. Now, there are some data security issues that China is concerned about, but it looks like they're less concerned about that based on this recent concession. That being said, I'm very surprised with this news. Now, the Chinese Securities Regulatory Commission and other national regulators are currently in the process of drafting a framework that will allow most Chinese firms to keep their listings. And this was stated by people familiar with the process who asked not to be named in discussing a private matter. Now, you guys already know how I feel when there's unnamed sources that are being cited for news. I automatically become critical. This is sort of like my auditor's mentality coming through. But I did the work to show you why I do believe that this news is reliable. But first, I wanted to show you why I'm skeptical, especially of Bloomberg News. And some of you guys already know this, but late last year, they put out this article saying that China was going to start banning tech companies from listing using VIE strategies, which at the end of the day ended up not being true. And so this is why I always say, take anything that Bloomberg News put out with a grain of salt. And it may not necessarily even be Bloomberg's fault because sometimes the people providing them with the information may not have all of the information. So who really knows what's causing this game of telephone? And I don't really want to blame Bloomberg News for this, but what I really want to say is that anytime big announcements like this come out, I really want to hear it directly from the Chinese regulator. And that's exactly what I ended up finding, because here on the CNBC article, it says that the Chinese Securities Regulatory Commission also told CNBC in a statement that it met with some accounting firms in the country, telling them to consider preparing for joint inspection. So that tells me that this is likely to be true. And so it's very clear with this information that China is really looking to keep their company securities trading on US exchanges. Although I personally never really cared about the delisting issues because at the end of the day, these things can just trade over the counter. It doesn't matter to me, but it really impacts a lot of investors and their ability to buy these securities. So this is just a good step in the right direction. But also what it shows is that China is willing to work with regulators in a way to protect investors. Now, with that being said, if you notice, Alibaba's shares actually didn't really recover that much based on the news. And then if you see Tencent shares, they also really didn't recover that much based on the news. And neither did Baidu's. And so the real question is, why is it that these companies' shares didn't recover, considering that this was one of the real headwinds and one of the real reasons why the stocks were trading down? And I really think it comes down to two issues that are happening in China right now. The first one is the COVID lockdown. So they've extended the lockdown in Shanghai as they've seen more and more outbreaks. And if you aren't aware, Shanghai is one of China's largest cities and financial powerhouse, and it's struggling to cope with the country's worst outbreak since the start of the pandemic in Wuhan. And China's strict zero COVID policy is now threatening to really impact the economy. And this is something that I've been saying for a long time on this channel. And a lot of you guys are saying this is just temporary. And I understand why you would say that this is temporary. But until the Chinese government, the CCP, right at the head, says that we're going to start relaxing these zero COVID requirements, I could see a lot of pain in the economy. And this is why I was really scared about the outlook for Alibaba for 2022. And we're now starting to see that reverberate with the understanding that other investors are having too. So the eastern half of China's biggest city had been due to emerge on Friday from a 4-day lockdown, but there was an extension announced late Thursday night. Furthermore, a lockdown of the western half of the city went ahead as planned on Friday morning, leaving the majority of the city's 26 million people still in lockdown. And this is just the latest sign that although China wants to stick to their zero COVID policies, and I understand why they would want to do that, it's really starting to impact them now. Economists at Morgan Stanley cut China's economic growth forecast for this year sharply, while Citigroup warned of risks to the second quarter outlook. Now, guys, just remember, the outlook for 2022 wasn't that high anyways. The Chinese government was already only expecting around 5 or 6% GDP growth for the year. So the fact that people are now cutting from that is really troubling for China as a whole. And analysts are saying that April as a whole is going to be horrible with the Shanghai lockdown extended. And this will reverberate regionally and globally as it impacts both demand and supply. And just an FYI, they mentioned that BMW has closed their plants and left because of the zero COVID policy, but they're not the only manufacturer that is left. There are tons of manufacturers leaving China right now because of these policies. It's getting too expensive for them to manufacture in China under these conditions. So that's a lot more headwinds to the local economy. And look, at the end of the day, if you want the Chinese consumer to develop, which is the core of the thesis for Alibaba, you need investment into the economy. Do I think that China can get through this? Absolutely. Am I still a buyer of Alibaba? Absolutely. I'm not selling my position. I'm a long-term holder here, but I do have to call it the way that I see it. And I know you guys love it when I do criticize my own positions, which is the only way that we should really be investing. I see challenges here. Now, the second challenging area that I see happening, which is probably scaring investors a little bit, is the continued Evergrande fallout. Now, more auditors are resigning over concerns over their off-balance sheet liabilities. This is a big issue because this is one of those things that's hardest to audit as an auditor. I have audited off-balance sheet liabilities in my past as an auditor, and it's really difficult because if management isn't truthful of what their true off-balance sheet liabilities are, it's really hard for the auditor to find those. So we really rely on management representation. Now, audit procedures may have changed since the time that I've been there, but it's just one of those things that it's hard to know what you don't know. Now, with that said, guys, you may have noticed that I've been away from the channel for a couple of weeks now. And the reason why is because I've been pumping out models for the Patreons, but I've also been buying stocks. In fact, this is the first time that I really went heavy into buying stocks since January of 2021. And why am I doing this? And a lot of people would say, look, you're buying the dip here, but you're going over a cliff. And the reason why they wouldn't be wrong in saying that is because we now have a yield curve inversion. And what do I mean by that? Well, you can see here that the 2-year Treasury yield curve has topped the 10-year rate. And that's a yield curve inversion that could potentially signal a recession. And so this article goes on to say, the 2- and 10-year Treasury yield curves inverted for the first time since 2019 on Thursday, sending a possible warning sign that a recession could be on the horizon. Now, that being said, just because there is a yield curve inversion doesn't necessarily mean that a recession is imminent, but it is an indication that we could potentially be going over the cliff. And that's what analysts talk about in the next part of this article, where they say that there's often a long lag time, and analysts say that there needs to be corroborating evidence before investors need to fear a recession is around the corner. And some of those corroborating evidence items that you should be thinking about are a slowdown in hiring, or a sudden increase in unemployment, or a reduction in manufacturing activity. Now, what are we seeing in the economy right now? Well, we have generationally low participation rates in the economy. We have low unemployment, and that's pushing wages higher. So we're not really seeing a slowdown in hiring right now. That being said, we are also seeing interest rates continue to increase and inflation causing people to tighten their belts a little bit. So it might just be around the corner where we start seeing economic activity slow down. And of course, just a little bit more data here. The yield curve inverted 422 days ahead of the 2001 recession, 571 days ahead of the 2007 to 2009 recession, which was the real estate crisis, and 163 days before the 2020 recession. So effectively, an inverted yield curve predicted the last 3 recessions. So once again, a lot of you guys and the people who've been on the Patreon calls are all a little bit nervous with me buying securities right now, which is totally fine. I'm dabbling a bit. I'm not backing up the truck by any means, but I am seeing some real opportunities here. And what I want to do is I want to point you to a quote that I heard from one of the first people that I read about when I started investing. And you guys would know who this is. Peter Lynch said in a talk many years ago that markets will continue to have ups and downs. The market at the time where he said this speech was around 3,800 points or 3,700 points. And he was pretty convinced that the next 3,800 points would be up and it wouldn't be down. But the next 500 or 600 points, he has no idea which way they'll go. And that's probably the best way that I can describe my position here. Although I am getting more bullish as the market is declining, I have no idea which way the market is going to go. If the market goes down further and things continue to crash, no problem. I got the gunpowder ready to really back up the truck, so I'm not worried here. But until then, I'm just going to buy when my personal signals say to buy. And what exactly are those signals? Well, here's where this channel, More Money, becomes very valuable, because one of the things that we do on this channel is there's no hype, and I'm always analyzing any company that I'm bullish on from a devil's advocate perspective, and I constantly do that. So you can see that one of the things that the Patreons have access to is this file, which is called Companies That I'm Following. And you can see on the top here that you guys already know that I love Alibaba despite all of the risks that I see in the Chinese economy. And you can see here that its current price is $110 per share, and I'm valuing it around $300 per share. This is no new news for you guys. You guys already know this if you follow this channel. So it's trading at around 36% of its intrinsic value. Now below that, you can see that there's 4 companies that are trading close to around half of their intrinsic value. And then below that, there's 15 companies that are approaching half of their intrinsic value. And you guys know some of these names. So you guys know that I really like Cardinal Health. I bought a little bit of it in 2021. I haven't purchased more since then. And another name that has been coming down is Zillow Group. So you can see that it's trading around 60% of what I perceive its intrinsic value to be. And I really like this company. This is because this company is really set up for an inflationary environment where they have low debt and their platform is somewhat inflation resistant. That being said, if you have a major housing correction, obviously Zillow's going to get impacted. But I think that's more of a short-term issue as opposed to a long-term issue. But we're at the worst level of affordability in a long time in the US housing market. So there's a bit of a headwind for the company, which is why the share price has come down. Now, of course, I've hit on a lot of the names, prices, and valuations here. And this is, of course, because this is something that's available to the Patreons at the $5 a month tier. And in that tier, you get access to all of the research, and there's so much research that's not even covered in that model, because there's other companies that we're looking at, and I'm pumping out models all the time. And so you can get access to that just at the $5 a month tier. And hey, if you don't like it, within the first month, just send me a message and say, hey, I tried it out, I don't like it, and I don't want to use this anymore. No problem. I'll refund your $5. Not an issue. I want you to get value from this. But I think the most important thing to mention, and I want to go back to that company I'm following spreadsheet here, is that the price of the securities is constantly updating because it's connected to a live ticker system. And so every day you're getting an updated share price as a percentage of intrinsic value. So in real time, you get the information necessary to allow yourself to make an investment decision in conjunction with your financial analyst, of course. Now back to Zillow. One of the things that I do want to do is I want to give you that Zillow model in the description in this video. But if you look here, you'll see that Zillow is now trading under $50 a share. And that's kind of where I was hoping it would come down to. And if you remember, when I first talked about it, it was around that $60, $65, $70 per share area. So it's nice to see that the company did come down. And that big drop that you're seeing in November, that's because they admitted defeat in their home buying division, and they completely got rid of that whole division. So when it came to valuing Zillow, we had to value the rest of the business and see what it looked like going forward. Now, Personally, I would have never bought Zillow had they continued with the home buying business. But the minute they get rid of that business, I like Zillow as a company and it becomes more of like a top echelon type company for me. That being said, if you look at the model, you'll see I generally model companies in an insane level of detail. I go down through most lines on the P&L and I forecast out each P&L line accordingly, and that's how I get to the EPS valuation. So when you get access to the Patreon, you get this for every single name listed on that list. But just to give you an example of what I'm talking about, the Zillow model I'm giving away for free, and you can grab it in the description below. You don't have to sign up for anything. You don't have to pay for anything. Okay, so I'm gonna leave it right there for you guys. Ultimately, at the end of the day, it looks like the delisting risks are gone in China, and that's a really good thing. Now, if you're not familiar with all of the stuff as it relates to the delisting situation, no problem. I'm gonna link a video right here, which will give you a lot more information.